We have seen the role of the treasury is changed phenomenally or increasingly because of liberalization. So, pre-liberalization, post-liberalization is the line demarcation, is called Lakshman Rekha. The pre-liberalization has started already. Treasury function was service oriented. Now they had to there are no customer contacts because they have to do only investment in government securities, or they have to take care of the cover operations of the foreign exchange. That's why customer had the customers have no focus on treasury, and probably customers don't know there's a treasury working behind the bank. So their contact point used to be only branches. But with liberalization, the role is increasingly changed. But subsequent to liberalization process, the treasury function became profit center. From service center, I have told it has become a profit center, and due to the role of the derivatives, the treasury is in direct contact with customers who regularly require such services. It means now the exporter wants to know whether rupee will appreciate or depreciate. If rupee appreciates, the exporter loses. Same way, importers want to have consultancy from the bank whether they should go for forward contract or not, because if rupee is depreciating, importers have to pay more rupee for buying the dollar. At that time, somebody has to guide them. So branch people, they are only involved in routine work like as accepting deposits, lending. They may not have sophistication in advising the customers with regard to dollar movement or euro movement or Japanese yen movement. For that, the customer has to definitely and necessarily perforce they have to contact the treasury. So now slowly the customer don't know there's a treasury existing, and the treasury also need not in touch with the customer. Slowly a interface started between the treasury and the customer because of the liberalization of the markets. Particularly large corporate clients prefer to deal directly with the treasury rather than going to the branch, because by the time you inform your demand and branch takes its sweet will and they come to the treasury, the market codes can change. So time is very essential. In a day, the volatility kills the market or kills treasury or kills the exporter or importer. So any decision has to be taken very quickly. If I come through a third party, the communication get distorted or communication is not reaching in time. That's why customers prefer to talk to treasury directly and get the opinion. They take the decision instantaneously. They take quick decision. Many corporate clients have their own treasury department, and they expect to receive an integrated service from the bank's treasury in areas such as hedging of export receivables, raising of foreign currency loans, and overseas investments. All these highly sophisticated advisors, all these technical advisors, probably branch will not be able to give, and that is given and it is taken over by treasury. Based on the discussion so far, the function of integrated treasury can be summarized. What are the functions once again to the students? Meeting the CRR and SLR reserve requirements, we have seen this. Domestic and global liquidity management. Now suddenly there can be a situation of rupee outflow and which a treasury has to manage. Same thing, suddenly there can be a rupee outflow, FCNR deposit get prematurely closed and bank has arranged for the dollar outflow, then a global liquidity management comes. Efficient merchant services, which include foreign exchange and advisory services. Now the exporters and importers want to know where the rupee dollar parity will be. Based on that, they want to take their forward contracts or opt-in contracts. So all these merchant consultative services has to be done by treasury. Optimizing profit by leveraging the market opportunities in forex market, money market, securities market. So the funds can transfer, it can move between these three markets very quickly, and treasury will try to optimize the profit or increase the profit. Managing the risk, and more particularly market risk. I already told you the maximum risk the treasury takes is market risk. Market risk nothing but liquidity risk, interest rate risk, foreign exchange risk, equity price risk, and all these risks the treasury should take informed decision after knowing what is the risk they are undergoing. If need be, they should also hedge or mitigate this risk. Assisting the bank in asset liability management. We have already seen under balance sheet management what is asset liability management. A liability I accept a deposit for 1 year, this 1 year deposit used for giving an housing loan of 10 years. So I create, the bank create asset liability management. The liability is short where the asset is long. How they have to manage? So from the usual traditional definition of accepting deposit for the purpose of lending a bank, now they are all called as maturity transformation agents. Now with customers or depositors knowledge goes up and up, they got umpteenth number of opportunities to invest, not necessarily in bank, they can invest in equity market, they can invest in mutual fund market. So with customer knowledge going up and up, that liability will always be short. So the ingenuity of the bankers nowadays is that how they will manage the short term liability which are funded for the long term liability. So this is called long term assets. This is called as maturity transformation. That's why presently we call bankers or maturity transformation agents. From the discussion, it again emerges that Treasury is expected to manage one, liquidity management. I told liquidity is the king of all risk. It arises only in short term. So we have discussed liquidity management in depth already. Next is proprietary position. Now so far in pre-liberalization, probably Treasury used to do the business only for the customer. Now post-liberalization, there is a chance, if beyond my customer, if the Treasury dealers also take position in the process, whether they can make profit. This is what, there's a change in scenario. That's why every Treasury is allowed to have a proprietary position. A dollar rupee dealer can take position in dollar. A call money dealer can take position, borrow in call, and he can again lend at a higher rate of interest if there is a chance. So these are called as proprietary positions. When the Treasury is made as a profit center, the dealers working in Treasury are allowed to take positions in equity, bonds, forex, of course subject to well defined limits and disciplines. These are the things which the dealing room has to follow very strictly. The third is like liquidity management, proprietary position management. The third is risk management. Treasury involves itself in managing the market risk of the bank as well as asset liability management. It means with short liability, the depositors are interested in parking the funds only for 6 months, 1 year or maximum 2 years. With that, the lenders are interested in taking housing loan which is minimum 10 to 15 years, or infrastructure loan which is more than 15 to 20 years, or a cash credit, even though it looks like a short term or a period of time, the cash credit also looks like a long term assets only. So today's beauty is that how the bank manages the short term liability in funding the long term assets. Now let us see Treasury and globalization, how it has happened. We will have some history to be talked. Let us first define what is the meaning of globalization. It is the process of integrating domestic market with global markets, characterized by free capital flows and minimum regulatory intervention. So under globalization, the capital looks for efficiency. If the USA capital comes to India, or USA capital can go to Indonesia, where the profit chance is more. So the international investors see and move the funds accordingly. If funds moving to India is better, the capital will come to me, or if the funds moving to China is better, the capital which has to come to India will not come here, it will go to China. So this is called globalization. Again, to repeat the meaning of globalization, it is the process of integrating domestic market with global markets, characterized by free capital flows and minimum regulatory intervention. The capital flows normally include the following. Let us see how the international capital flows takes place. It can take place through portfolio investment. Foreign institutional investor, they come and invest in our Sensex or Nifty. So foreign investor investing in our country's equity and debt market. Direct investment, it is also called as foreign direct investment. Samsung, LG, they are the biggest corporates of South Korea. They come and invest in our country and they set up factories, they put money, capital, and out of this they try to take profit. So direct investment, it is also called as FDI, foreign direct investment. For example, Hyundai Motor Company investing in India involved in manufacturing costs. External commercial borrowings. Now borrowers not necessarily they have to take only from Indian banks, they can take from abroad also in the form of ECBs or external commercial borrowings which are linked to LIBOR rate of interest, and this rate of interest is less when compared to our base rate mechanism. So Indian corporates raising foreign currency loans from abroad at competitive rate of interest linked to LIBOR. Issue of equity in global markets. Now our corporates, instead of listing in a BSE or NSE, they can list their share in USA or on Europe. Number of our corporates have listed their shares abroad. So issue of equity in global markets like debt market, our corporate can raise equity from abroad in the form of ADRs and GDRs. Merger and acquisition, this is also possible. Our corporates can take over some of the biggest corporates abroad. It can be domestic or international. To quote an instance, Tata Sons taking over Chorus Iron and Steel of UK. Then it was a big deal, running about 64,000 crores. Now Indian Tata Steel is controlling the steel market of UK. Others, beyond this, others are payment for technology transfer, royalties, financial services, etc. So this is called treasury and globalization. We have seen from 1991, the markets is getting liberalized. Any liberalization, definitely it will be followed by volatility in the stock market or exchange market or wherever it is. All the above capital account transactions may further create current account transactions such as servicing of interest on ECB, payment of dividends on ADR and GDR. Let us see that a person, instead of taking the loan in India, he takes it outside in the form of external commercial borrowing. See, a loan is coming from abroad in the form of dollar, and that loan has to be serviced by way of interest. It means this capital account transaction is followed by a current account transaction. Same way, let us think that our corporates are listing their shares in ADR in US market or GDR in European market. Naturally, every year or whenever the balance sheet is finalized, they will have to pay dividend, which is again a current account transaction arising out of ADR and GDR. It means a interest transaction arises out of an ECB transaction, or a dividend payment arises out of an ADR GDR transaction. However, the free flow of capital creates lot of volatility. I told that when the capital flows very freely, it looks for efficiency. So suddenly, if the international investor find efficiency in investing in China, they withdraw from here and put the money in China, or they find investing in India is good, they withdraw from South Korea and put it in India. With the result, the capital flows creates lot of volatility. So when there is high inflow, the rupee appreciates. When there is a very outflow of foreign fund, the rupee depreciates. It means it affects our exchange rate movements, and incidentally the volatility of the rupee dollar parity also. However, the free flow of capital creates lot of volatility for the countries. Such a situation was witnessed in Southeast Asian crisis in 1989-90. We have seen in one day the Thai baht of Thailand got depreciated, the Indonesian, the Philippine peso got depreciated. All these things we have got in one day. In a week of 10-15 days, all the local currencies depreciated beyond a limit. So such a situation was witnessed in the Southeast Asian currencies in 1990s, and countries such as Thailand, Philippines, Malaysia experienced sudden depreciation of currency. So now a situation comes whether I should liberalize or I should put control. So you think that if you liberalize too much also, it is bad. If you put too much of control also, it is bad. So a via media is to be done. So when you keep on liberalizing, you should not lose sight of some of the controls. So this was a lesson arising out of Southeast Asian crisis, and again any liberalization should be followed carefully by applying some rules and regulations. This what, hence countries started imposing capital controls. It means a lesson is arising out of, even if a free flow is there, it leads to high volatility. High volatility affects my market, and again I will have to put some controls. Hence countries started imposing capital controls. In Asia, Malaysia was the first country to impose controls on capital movements. Malaysia has put some tax, it's called Tabin tax. They said that for any inflows, they will have to pay some interest for the inflow of money into a country. These are all, I don't want too much of inflows also, I don't want too much of outflows also. This is what present day the countries follow. Government of the most of the emerging countries have placed several regulations on cross-border movements of the capital. This also, in fact, purely if you see Basel III, it is a fallout of global crisis also, and it has put Basel has put lot of conditions on improving the quality of the capital of the banks. If we take the case of India, pre-liberalization, there are a lot of restrictions on foreign exchange transaction. Now again go back to pre-liberalization, we know it was followed by a lot of controls and all these things. At that time, any foreign exchange transaction, it used to be controlled by Foreign Exchange Regulation Act or FERA of 1972, because at that time the inflows of foreign currency was less, so naturally government has put lot of restriction for outflow of currencies. So that's why even $1 to be taken out, you have to look to the RBI whether it has been taken or not. So a control was followed very heavily. The forex transaction was strictly controlled by RBI. That's why RBI at that time, it was called as the government authorities were called as the controller of exports and imports. RBI had a department called Exchange Control Department. Everything was controlled and regulation. Any violation of forex transactions, anything violated under forex transaction, as per FERA, that is Foreign Exchange Regulation Act, it was treated as a non-bailable criminal offence. It means the exporters and importers, even though they do the trade, they can be uncuffed and taken inside the prison by the police. That's why any violation of FERA is called as non-bailable criminal offence. The controlled regime was not contributing to the growth of country. We have seen, let us see the growth of India from your independence to pre-liberalization and growth of India from 91 to today. Definitely people say the growth from 1991 was any time better than the previous growth. So the controlled regime was not contributing to GDP growth. That is the reason government took a turnaround and they followed liberalization process. That is the reason we adopted liberalization process from the year 1991. Since 1991, RBI started permitting large movement of capital, both inflows and outflows, either by automatic route. It means government RBI has permitted up to certain limit, don't come to me. You follow, you can remit, no questions are asked as long as you have got sufficient balance in your SBR current account. That's why it says it can be automatic remit or limit, or it can be approval limit. Beyond a limit also you come to me, if based on the merits of the case RBI permits it. That's why there are two routes called approval route and automatic route. And at automatic route, you don't look to RBI, you follow some certain rules and conditions, you can repatriate your dollar funds outside. So it's called automatic route. You want to exceed the limit, again take the permission from RBI, that's called approval route. So RBI started permitting large movement of capital, both inflows and outflows, either by automatic route or through approval route if the requirements are more than the prescribed limit. The regulation gave way to development and maintenance. So I don't want to control the market, I allow some free movement there. That's why RBI, our regulators, started focusing on development of the market and continue to maintain the market in a developed stage. In the process, the following steps were taken. It means I want to move away from control regime to a development regime. That's why the Act FERA was repealed, and in its place an Act FEMA has came in 2000. So Foreign Exchange Regulation Act got replaced by Foreign Exchange Management Act 2000, which came into existence. Any violation under FEMA, it is only a civil offence. I already told you, any violence under FERA is non-bailable criminal, any violence under FEMA is only a civil offence. The government department, which was called as Controller of Export and Imports, it is now changed as Director General of Export and Imports. There is no word controller or regulator, all these things. The RBI department, which was called as Foreign Exchange Regulation Department or Control Department, now it is called Foreign Exchange Department. With the continuous liberalization, most of the capital flows now take place by automatic route with a minimum regulatory intervention. Everywhere the control is replaced by relaxation, maintenance and development. We saw first the regulator means who is regulating the market is first genuinely interested in development of the market. He wants the markets to grow. That's why regulator has taken over the function of development of the market also. However, recognizing the risk of uninhibited capital flows, RBI has not permitted full convertibility of currency, and we have seen if you deregulate too much or if you follow liberalized, India can also go in the way of a Southeast Asian crisis. That's why RBI is not allowing the regulation freely, it is doing it in a phased manner. Still it has got some controls and not allowing us to go for full convertibility of rupee. It means full convertibility of rupee can lead to capital outflow of capital also. It will create lot of volatility and rupee may depreciate beyond a control. We have seen such things in August. We have seen rupee reaching the level of 68.81, and from there, because of RBI's lot of action, it is now trading at 62 or 61 rupees per dollar. In fact, due to the recent high volatility, particularly which happened in August 2013, RBI has again imposed several restrictions on forex transactions. Under liberalized route, individuals were permitted to take about $2 lakhs per year. Now the $2 lakh is now reduced to $75,000. It means RBI thought it, now put some controls, otherwise there will be, it has witnessed lot of outflow of dollar funds, so it has put lot of conditions and controls now. Now let us see what is the role of RBI and its exchange rate in the liberalized mechanism. Once again, pre-liberalization, RBI used to have 100% control on foreign exchange transactions. It means you want dollar for an importer, the branch has to apply on behalf of the importer and get the dollar, or a dollar that is got from the exporter, it has to be, a bank has to sell only to RBI, not to others. But with 1991, after liberalization, we have seen the foreign exchange market got liberated and many players are playing now. Presently, though RBI is following a managed exchange rate regime, rupee exchange rate is effectively free float with a minimum intervention from RBI. RBI allows the market to go up and down. With the opening of the borders, the exchange rates are further influenced by macroeconomic factors like inflation, interest rate, GDP growth, stock market, etc. Pre-liberalization, RBI used to control the rate, only one rate. Post-liberalization, the rupee dollar was allowed to move up and down. How it moves? It moves on micro and macro fundamentals. Probably micro is restricted to the bank. Macro is, if my GDP growth is good, India attracts lot of inflows, that inflows leads to rupee appreciation. And if inflation and interest rate goes up, the interest rate, the differential goes up, leading to depreciation of rupee. So with the opening of borders, the exchange rates are further influenced by macroeconomic factors like inflation, interest rate, GDP growth, stock market, etc.